Hey guys and girls, Daniel Walsh and Your Property Wealth. Today, I'm going to talk to you about the market, the economy, in interest rates. So 4 years ago, I did a video about why savers are losers. It was very controversial at the time, where a lot of people, thought that saving was the way forward. You needed to save money in order to get ahead. And what I was sort of saying was, savers were becoming losers because they were getting wiped out over the next decade when the inflation came. And I said that when the inflation came, it would devalue people's savings rates so quickly that their purchasing power would be lost. Well, fast forward 4 years, today we have seen that inflation, and that inflation is starting to play out. Now, the inflation has been devaluing savings, and a lot of people that have had savings has had that devalued so much that their purchasing power against things like assets and food and stuff like that has dropped significantly. So those people are now feeling the pinch. Now, what's happening today? Now, today what we're seeing is interest rates have now hit rock bottom at 0, and they're now looking to start to reverse interest rates and push them up. The problem is the long-term trend is interest rates go down, level of debts have to continue to increase because we're drunk off the printing of money to keep the economy from going into further recessions. The problem is with this is we have never recovered since the last recession, the 2008 recession. And what they've done to warn off further recessions is continue to print money and to continue to pump everything up. And now what's happening is they're getting so high inflation that the level of debt that they've got, they cannot fight it with the interest rate, because the interest rates, if they push up interest rates, they are going to reverse and they're going to see the economy decline straight away. And we're starting to see that in things like sentiment surveys and things like that. So how people perceive their wealth right now, and they're starting to go, you know what, I'm going to save more money, I'm going to hoard more money, because as soon as the talk of interest rates, people are thinking, I'm going to save money. So what are they going to do? They're going to raise interest rates, but what I'm thinking they're doing is they're going to be raising interest rates so they have something to cut from the next time round. Very much like 2018, in America, they actually were raising interest rates. Now, they raised interest rates and they were talking about how they were going to normalize interest rates. And it didn't take very long until they reversed the interest rates. And that's because the credit market liquidity was no longer there. So all of a sudden they had liquid markets in the credit market. So therefore, they had to reverse interest rates very quickly. We're also seeing things like, if you track the bond yield curve. So as soon as we talk about interest rates hikes, as soon as we talk about things reversing, the yield curve inverts. So what's actually happening there is it's basically saying that if you keep going in this direction, we will head into a recession. And the economy is not getting any better. It's why the interest rates long term have gone down, is because the economy keeps getting worse and worse and worse as we take on more debt. So what they're doing is they're kicking the can down the road, essentially. So nothing's changed. Interest rates are going to stay low. They cannot have interest rates rise. People talk about, 10% rise, 15% interest rates. Back in our day, we had, 10 or 15%. And the thing is with it, to actually, with the inflation rate, right? So if you have inflation at 10, 15%, to get on top of inflation, you generally have to raise the interest rate to level out the inflation rate or higher. So when we're talking now, we can't actually get above 10 or 15% in interest rates. We'd be lucky to increase interest rates 4 or 5 times before we see every indicator scream recession. So what they're going to do is going to push interest rates up 3 or 4 times, then they're going to reverse them and cut straight back down as soon as they believe that the markets are going to falter. And we know this because when COVID hit, they were willing to throw everything at the economy in terms of printing as much money as they possibly had to, freezing mortgages, whatever they had to do to warn off recession. So spending all of that money and showing their cards early on with the COVID has basically shown what they will be willing to do next time round. So interest rates cannot rise long term, they cannot sustain it. They will rise 1 to 4 times, and that period of time where interest rates rise is going to fool a lot of people. And the reason it's going to fool people is because they're going to think it's going to keep going. It's our natural instinct to think everything's going to go to the extreme, right? So if interest rates go down, it's going to go down all the way to 0. When interest rates go up, it's going to go to 15, 17%. When the market's going to go up, it's going to never stop. When the market's going to go down, it's going to go down forever. That's what human nature does. Whereas what's going to actually happen is we'll push interest rates up 1 to 4 times, we'll then reverse interest rates, and that period in between where the media is going to be drumming it up and they're going to be saying, hey, interest rates, are going to go up here, the economy is going to crash. The economy is not doing well, yes, but there's no way for interest rates to rise long term and to sustain that without a recession. And as soon as that happens, interest rates will reverse. Now, when interest rates reverse, that's when the next stage of the push of the cycle will happen, and we start to see the flame reignite again, and we'll see, credit become easier, and that's because they're trying to warn off recession. And then all of a sudden, we will see a lot more stimulus, and that will come into the market as well. And what we will see at that point is the property markets will have like its second wind, and it'll keep growing from there. Now, if we look at markets today, what I see happening is between now and that middle period where interest rates rise that 1 to 4 times, is I actually see that the Sydney market will probably plateau and drop a little bit, maybe 5 or 10%. Now, I see the Melbourne market sort of leveling off and going flat, maybe a small drop in some markets. I see other places that are more affordable like Adelaide, Perth, Brisbane still continue to increase, but increase at a slower rate. So those markets are better for investing, going for more of that affordability, where there's still jobs created, the economy is really strong, population growth, interstate migration is really strong. When you go to those markets, you'll do quite well. I think the higher end markets that rely on interest rates like Sydney, they're the markets that I would sort of stay clear of at the moment, unless I'm buying my own PPOR or something like that and I'm going to live in it long term. Now, property markets will not crash. Everyone will talk about the crash, and that's what they're going to talk about next, 30, 40, 50% drops. It's not going to happen. The reason that won't happen is because what's happening is we're seeing a lot of supply shortages, meaning that the price of buildings going through the roof. So yes, we can raise interest rates. Yes, we can even slow down the building game. However, when we're slowing down building and we're building less properties and the demand slows down, the equilibrium is still there. So therefore, the supply and demand would still be fairly healthy. We're actually in a chronic undersupply. So what we're going to see is the prices soften in Sydney. Other markets will still rise, but at a slower rate, but they will soften, they will not crash because of the inflation that's causing prices to be a lot higher. And also it's causing a lot of builders to go broke. So we're seeing a lot of builders go bankrupt, therefore there's less builders, we're seeing less builders, we're seeing price hikes in building, and we're going to see a lot less buildings go on. So therefore, as if there's a lot less people building and developing, therefore the supply just dropped, and the demand, even though it drops, will still be okay for supply and demand. Now, the rent market is going to be what increases dramatically. And the reason being is that there will be that middle period where the interest rates rise. Now, the interest rates, when they rise, will probably only rise for maybe 12 to 18 months, and then they'll reverse. Now, when we get to that, 12 to 18 months, the next, let's say call it 2 years, we're going to see rents rise dramatically. And the reason being is because those people in that period of time, investors, a lot of them will not invest. And therefore, because they're not investing, we're going to see less houses for rent because there's less people buying rentals, but we're going to see more people needing to rent because they can't save money because the inflation is devaluing their savings. So therefore, we're going to see rents rise probably a couple $100 a week in a lot of markets within the next year and a half. So we're going to see massive pressure on rents, which is, good for investors because they're going to get better returns, which will set everything up for the next time round the market booms, because when the rents rise, the yields rise, and then all of a sudden when interest rates turn around and we see them start to drop again, that's going to create another big boom for the next round. So it's keen to understand this and understand that the markets really can't crash. They will not let them crash. We've already seen that. And then also to see that where the markets are heading, what's happening with the interest rates, how interest rates and why interest rates can't rise. So that's just what's happening on the economy side of things, that's what's happening on investing side of things and the markets at the moment. Hope you enjoyed the video. Please like, share and comment. Till next time, guys. Have a great day.